July 2017. I've just posted a video yesterday, one of the insider videos that I put out at the mid of July, and that was a follow-up to the June long short report. Now, June month we closed actually down for some of the key indices after almost a 5-month run. In fact, the mid-cap indices closed the month of May down. So, having done that, one of the things that I was exploring strongly at the end of June was whether the entire move up was actually complete. And if you've seen my long-term count, which is on the home page, and it's updated every week, so you should bookmark that page. And if you've not seen the video prior to this, you'd probably want to see it to get an idea of how it was possible to project 10,100. But what you'd also find in that video is that I don't sound too enthusiastic about it, but it was a projection on those charts. And the reason is that I've been marking this entire run up as a B wave on the long term, and so far we are in the third wave of this B wave. So B waves are essentially 3-wave structures, and the reason I've done that, which is almost against what 90% of the people are doing, which is marking everything as a 1-2 since 2009. B waves tend to be corrective patterns. They typically would be a retracement to the previous move down, and this move starts from 6800, so a retracement to the entire previous leg. But in a rare case, we get something known as an expanded flat, where the B wave can actually move to a new high above the previous high. Now, it can be a dangerous pattern to really presume, because what if things continue to go on? So you have to really take that view based on the market internal structure, various reasons you can put together to really look at it from that angle. And so that's what I have done. And the essence is that B waves can end at key Fibonacci retracement levels. There are two in the case of an expanded flat. One is the 123.6% level, which was at around 9680, which is what we'd achieved in the month of June. So essentially the thought was, if we'd completed the structure, then July should have been a sell-off. We started with an initial dip, but then the 9712 high was taken out, and once that was taken out, then you have to consider the next 138% mark, something that I was not thinking, because you closed down for June, but then once you did that, then the projection of that was around 9990, which is very close to the 10,000 mark. And of course, as the video explains, once the pattern actually develops, then it's possible for you to have projected up to 10,100 by the mid of the month, which was achieved at the end. You also got close to 10,030, so that was almost close to the 138% mark, where we paused for almost a week prior to expiration, and we could have concluded something there, but some of the videos I put out last week were essentially that the rally till there was only a third wave, and it was possible you still had a fifth. One of the strongest moves was essentially in the Bank Nifty, and Bank Nifty did not give any sign of pausing or reversing throughout this move, and so there was little doubt of a reversal there. In fact, even yesterday, as the Nifty sold off from the highs, and it's possible to mark this most recent rally from the July low to beginning to end as a 5-wave. On Bank Nifty, you still don't have the final levels of clarity, and intraday also it held the 20-hour average, bounced back, and it's possible that as we head into the RBI meet next week, we do retest the upper channel lines, which means make a minor new high, or maybe even stretch beyond that once again into the coming week. That said, the Bank Nifty has become pretty overbought. The RSI is hit 84, so if it does manage that one more move up, you'll probably see readings above 85, 86, just into the RBI meeting. Now, what's going to be interesting here is the expectations, I think, are pretty much getting built up. No one's really talking about the the pressure for a rate cut as of now, though when the data came out last month for the inflation and growth, then I think everyone started to point out that why the RBI had not really cut rates, and why weren't they doing it after that data point. So I think that people are going to again start focusing on the potential that RBI starts cutting rates this week. Everyone's eyes were probably on expiration and the Fed meet itself. I think there are a couple of so apart from having been focused on the Nifty completing a larger degree pattern against what most people are thinking. Some of the macro trends, you always get some things right, and among those, I think one of the biggest trends that I captured right from the start of the year was actually the falling dollar. And the falling dollars continued into this week. I think it's become significant at every level. People have said no, it will stop here and bounce back. Those who have reasoned the rise of the dollar for completely different reasons. For example, some people have thought that the rise of the dollar was essentially related to rising interest rates when interest rates had really not gone up throughout that time period. So I think the whole reasoning was wrong. So I'm just going to get into a little bit of what this dollar move really means in my thoughts. And I think I've done a couple of videos on that entire idea time frame, but it's important to get into it once again. And also, if you got that right, then I think you'd have a macro big picture of what you should expect in the coming 6 to 8 months. And so it's very, very important, because you've just turned from what was a dollar bull market into a dollar bear market. At least that's my opinion, and most people are still thinking that in some way this would end up being a correction to the dollar bull market, and the dollar bull market will actually resume. And I can't see that. And if you're trying to do that, you should probably study a whole bunch of cross rates. And you can't see it on the BRL, you can't see it on the AUD, you can't see it on the CAD, you can't see it on most pairs. I mean, there are a couple only. I think the GBP is the only one that I've written about still having a fifth wave pending in terms of falling against the dollar. So there would just be that rare instance. Of course, I do think the USDNR's long-term fifth wave is also incomplete. We've only completed 3 waves from the bottom that it made in 2008. So the first rally was 2008, 2009, then 2010-11 you got wave 2, and then the rest of the structure was a third wave, and we are right now in a fourth wave correction for the USD-INR, and the fifth wave is still not complete. So the only question is, does it start from the recent low, or will we break the recent low before you start the fifth wave for the USD-INR? So that's something to watch out for. But clearly USD-INR is not showing the kind of momentum for you to really build any trades into it, and which is why I've not really been writing about it. So that brings us to the dollar. I think the fall in the dollar and the potential for commodity prices to rise is something that I latched onto, and rightly so, and its impact has been positive on most metal stocks. And my sense has been that as long as that thematic is playing out, it will continue to do so, even if we are in a weak market environment. But of course, when equities do go into a corrective mode, it's not possible that stocks that are doing well also correct. That's a natural part of it, so everything would correct, but outperformance essentially happens as and when those rallies occur. So I don't think the commodity rally is over. In fact, this week itself, everybody would be thinking that crude is going to break the $40 mark. Nowhere close. I started projecting upwards once again, and it clearly played out, and it's still not over. It will probably go back above the $50 mark, go to 54, 55, maybe even 60. There's a longer term projection which I made at the start of the year, which will be completely absurd, but it's, if you take the falling trend line from 2008 to 2010, it comes in closer to the $90 mark. If not 90, think about at least 70, and I know that kind of level would only happen in the current state of affairs if there's some geopolitical event, but we don't know. There are too many moving parts. One of them is the falling dollar itself, which drives up commodity prices historically. So when was the last time you had a dollar bear market? Now, that's the most recent event would be 2002, 2003, but really go back a little into the 90s. Essentially, each time you've had a dollar bull and a bear market, you've seen flows. So when you look at currency markets in a free floating currency environment, what you should think about is, where is the money flowing? And I think that's the essence of reading into currencies, rather than the old metrics of interest rate parity and various other tools that allowed you to make those forecasts. So if you look at what happened in the 90s, you had the US booming versus many other places, and the dollar was very strong, and it continued into the latter part of the year, latter part of the decade. And as that happened, countries that faced currency risk, essentially you had the Southeast Asian crisis, you had a Russian crisis, you had LTCM, many of these events because of the dollar rally, and money was essentially flowing into US stocks and equities. Now by the end of that decade, if you've read a lot of people who wrote about US's debt and deflation crisis right after 2000, especially mostly I think it was Prector who was writing about that more than other people. Others latched onto it into the 2006 7 period, once the housing bubble and debt problems became even bigger. But the point is that at the point of 2000, when the tech bubble rolled over, essentially you saw the dollar bull market turn into a dollar bear market. And essentially, the way I read it is that money moved out of US assets because of the fear of, one, of course, the NASDAQ bubble ending, and the second is what would be the impact of these, debt related problems. And of course, they were cutting rates incessantly. So the money moved out. It moved into various other assets. Initially, it would be commodities, it would be gold, silver, and once you had a commodity bull market picking up, you had countries which are net producers of commodities, emerging markets, so from Australia to Brazil to Canada, Russia, all of them actually starting off bull markets, and India also being in the emerging market pack actually started off into that move. And so you got a bull run in emerging markets as a whole and in commodities as a whole, as money moved away from US assets into other assets. Now, of course, the US market itself did well in that time period. Uh, and in fact, there's an interesting chart that I plotted today, and I'll talk about that as well. As you simply look at the Dow in currency terms. Now, of course, you could do inflation terms, gold terms, and so on, but currency terms was interesting one. And the point is this, that if you're looking at where the money is flowing, you're also looking at, are people making money in that currency. So if you just take the late uh, 90s, why did you have a Southeast Asian crisis? Why did India face a crisis in 1991? It's essentially when you have a currency crisis, then foreign money does not want to go there, or essentially if they're already there and if it's speculative money, then it wants to rush out, and that's what caused the Southeast Asian crisis. That a lot of hot money that had moved into that place. Moment you had a rising dollar causing a currency crisis in each of these countries, money is simply rushed out, further making the troubles worse, and the stock markets collapse. So the point is that what happens in a similar scenario when the dollar is falling. So one way is you measure US equities in dollar terms. So coming back to the point, once you had money move into various of these assets, once the housing bubble popped, you had money essentially moving back. So there was a demand for dollars because of the crisis, the losses that US banks, corporations were making, and they'd invested all over the world. They were pulling that money back, and the Fed had to step in and stop that reverse flow from happening. So that reverse flow caused commodities to crash, it caused equities to crash, and essentially once they printed enough money to give to the bank so that they stopped pulling it out, things stabilized, and you got the big rally that started from 2009 and continues to go on today. But the key factor is what happened to that dollar rally. So you note that you had a dollar rally start in 2008-9 in the midst of the crisis, and then once the US printed a lot of money, the dollar actually started to fall, but it didn't make a new low, and it stayed down there consolidating all the way into 2014. And then you got the next big wave in the dollar, and this one occurred because while the US had done significant amounts of bailout for its own businesses, other parts of the world had not gone that aggressive. And when their currency started to fall off because of similar steps and because of troubles in their own economy, you had problems in Europe, you had problems in China. Then money moved from many of these places. It moved out of Europe, it moved out of China, it moved out of Japan, from everywhere, and moved into US assets. And essentially it moved into US bonds as a safety bet, and it also moved into US equities and US real estate. So if you're someone in the US, you'd know the amount of Chinese buying that continues to take place, not just in US but also in Canada. They would essentially be 2 years back talking about Chinese buyers coming in and making cash purchases. And what they essentially meant by cash purchases, that these were not people who would take loans within the US and buy, which is what they meant. They meant the people who are bringing money from China, simply paying the entire amount upfront and buying places out. So a lot of this foreign money moved into various US assets, and it made great sense because you have a rising dollar, you have a rising market, so you have a dual gain to really make out of it. Now in 2016, the first time the dollar looked like it was peaking, it actually made its final top only this year. But a lot of markets took that initial cue, and so you note that emerging market currencies like the Rial or the Russian ruble and all, they all uh, bottomed out and started to rise from 2016 itself, when gold also bottomed at 1050. So that was my call even back then, that you'd see a complete asset class reversal in at the start of 2016, and that started to happen. Although India continued to fall because of RBI's measures to get banks to report their losses, but that trend changed from mid of Jan itself, and that trend continued all into this year. So even when the dollar made its new high in 2017 January to 104, 105, which was a new high, but it was not a runaway move. Many of these currency pairs did not react to what was happening in the dollar pair, and that gave an advance signal that this was just a false move. And when you looked at it technically, 66% retracement of the previous dollar bear market, it was sufficient to make that call, and that's what I wrote about. I've been writing about, talking about since January, that the dollar bear market has resumed. And now it's more broad based. It's spread to many more currencies. Some of them have broken the initial lows they made last year. The AUD just did it in the last month. CAD did it a little prior to that. And the currencies that have not really broken their recent lows are actually the Brazilian real and the Indian rupee, which often tend to correlate. Now the big question is, will this strengthening go on, and will it be a driver for many of these equity markets just the way it was after 2003, 2004? And I think that's the big question. Typically, if you make that relationship, then you'd say that the dollar's falling, you'd not only buy commodities, but you'd buy all emerging market stocks and equities, and that would be the big trade. So far, that has been true for the last 8 months. Essentially, money is moved into emerging markets as the dollars continue to decline. But I'm just raising this red flag, and I'm raising it week after week, month after month, that my sense is that if a rising dollar was essentially a flow into US assets, when you look at a chart of the US assets relative to the dollar, so you look at a Dow dollar chart or a Dow euro chart, and I plotted one today, and the Dow euro chart essentially peaked in the month of February, which means since February you've not made positive returns. Now it may have dipped by 5-6%, which may not look like much because you've had a significant rally over several years. And if you had these gains, 5-6-7% dip so far might not sound like much, but essentially the point is that in currency terms you've actually peaked. And if the currency decline becomes a collapse, which I think nobody's anticipating, but if I'm right, this is a dollar bear market just in its infancy, and it's likely to be bigger than the previous two bear markets. I'll probably post a chart in the next long short report of what I think, because the last one I gave a more conservative target, but if you think about it, there's a triangular structure all through the last 2 decades, and some people thought that triangular structure was essentially a pointer towards a dollar bull market. You did get one. But the triangular structure may be a reverse triangular structure, and in that case, why not anticipate a major dollar bear market bigger than the normal sizes that you've seen before? And if that's the case, then what does it mean? At some point of time, investments in US assets are going to start looking like they're actually losing money, and if all the money that is invested in US assets essentially come from or not all, but at least a significant portion has come from foreign buyers, which would be across from China to Europe to Japan and many other places where money stored up from various countries that are able to move money. They've probably moved it the most into US assets because that's where the returns have been. When that money flow starts to reverse is where the risk lies. So imagine you've already seen the US bond market sell off last year, which I think is the first wave of the sell off. You've been seeing my posts on bond yields. They spiked all the way into December. Now usually you have an inverse relationship between bonds and equities. So when you see yields go up, equities continue to rise. When yields go down, equities are actually correcting because money is moving out of equities into bonds and so on. But there's always a trigger point, just like there was in 1987. You had a bear market in bonds and yields spiking up for several months before that event that is often quoted. And it's only at an inflection point where yields went up too much that everything simply gave up. And so that's the point. You're entering a third wave for US bonds, and you're already seeing a build up in yields around the world. I posted the German 10-year yield chart. I've seen a very, very small 5-year advance in the, which I mentioned in the long short report, in Indian G-Sec. So people are anticipating that the recent lows for Indian bonds would break. What my sense is, this is an early advance. You're in the very, very early phases of rising yields. It may not happen immediately, but it will happen at some point of time. And so if next week the RBI steps in, cuts interest rates, which somehow I think he probably would not, given the projections he's already made for inflation for the rest of the year. He'll probably wait a little longer. But if he does, I think the bond markets will only have a temporary impact, and yields will actually go the other way, in line with what is happening in US yields, which are slowly inching up. People are still anticipating that bond yields will drop, but my sense is that they'll continue to rise, given the structure of the patterns that has developed so far. You've already started the next impulse wave, and so my sense is that the recent highs will hold, and you'll see a further jump in yields in the coming month and months into the end of the year. So when that happens, I think that will be a risk factor that people start weighing it at some point of time. And simultaneously, if you still have a falling dollar, which is got more to do with flows than rates. So if you're thinking that interest rates, bond yields go up, then it's going to drive the dollar up. That's unlikely to be the case, because if bonds are falling, and that's where all the money is gone, when foreign investors start selling US bonds and moving out of them because of the losses, it's going to cause the dollar fall to only exaggerate. And the same thing will then flow into equities. That 6-7% loss doesn't look like much, but if you see the dollar index fall below the 90 mark, and then suddenly slips at a much faster pace, going down to 85, 84, 83, that's at some point of time going to cause a panic, and foreign investors would be seeing currency losses in a very similar way as you see when investors in emerging markets, or in markets like ours, like the Indian market, which has a lot of foreign borrowing, at least on the corporate side, or which has always had a import dollar issue. Even though we have built up reserves, but we've always faced that crisis from time to time. Brazil faced it when their currency was falling. Their bond yields had shot up a lot. So places where bond yields are an issue, their currencies would come under pressure. And that would in effect impact their relative equity markets as well. So this is a very, very different time period. None of the economic factors are the same as they were in 2000 and 2002. So simply projecting that you had a bull market in many of these markets when the dollar went into a bear market back then, and you'd see a repeat of that right now. It's possible. I'm not saying it's not, because if the dollar bear market results in a hyperinflationary event, then equities, as you're seeing in Venezuela right now, it went. The Venezuelan index went from 120 in 2012 to 134,000. I think right now that's more than 1,000 times move. So those type of moves. That's a wild scenario. I'm not saying that's the likely case, but when you do get high levels of inflation, then the markets actually adjust upwards to it. But at the same time, the high debts and higher interest rates in many of these markets would also put pressure on equities. So if you do not have, unless you have runaway inflation, equities would come under pressure, is how I would put it. So if you have some level of inflation because of rising commodity prices, which is, let's say, in a wild factor, oil is at 90, copper prices do go up the $3 to $3.50 mark. Gold does move up another 20-30%, 40% from here. That would not completely be a hyperinflation. It would just mean an elevated level of inflation. But the resulting high interest rates and the falling dollar would have a multiplier impact and more of a sentimental impact on investors who've been betting on the long dollar trade and investing accordingly. So I think that's something to weigh. Watch those markets and what they're doing, because they could become the trigger points in the coming months, and that's what I think is the case. But like I said, I do expect a falling dollar to result in higher commodity prices, and I am keeping a special focus on the precious metals, where I expect something far more different to happen, which I've already published. So You can read about that, and I think that those are the key factors that you need to watch in the coming months. Now, you do have elevated sentiment on our own market because as you ran into this month-end closing, this month had one of the highest put writing experiences. The last time it happened was in September of 2010, a month or two prior to the peak that we saw then. And since then, well, we've had writing many times reach high levels when markets rally, because option sellers, or rather those who are bearish buying puts, or option sellers selling more puts out of their confidence that the market is up, would be high. But that was the highest level reached back then, and that level was retested this month. The net called minus put open interest hit 40,000, almost 40,000 crores. It had reached 40,000 crores back then, and it reached 39,000, some number very close to 40,000 crores. In fact, if you actually look at the total data for the last and final day, because the market was up on expiration date, would have actually been more than 40,000 crores. So I think that that was a major event that happened, and that actually pushed up your put call ratios to a very high level. Now, you'd think post expiration that would be done, but that was not the case. On Friday, as the data came out, the put call ratios continued to remain elevated at very high levels, which are usually associated with market highs. So a lot of people are beginning to look at that. Good reason for getting some pullback. And they would probably be looking at a pullback to enter into, but as I'm marking this entire structure as a B wave, what I'm looking for is its completion and the resumption and the start of probably wave C down when it happens, rather than simply a buy on dip scenario. So I think that's where I differ with I don't know, is it 90% or 99% of the people out there? I have no idea how many people agree or differ on that. Because to the bulls it looks like everybody is bearish, but I think that's not really the case. The sentiment data does not show that. Most people who are on the long trading side have essentially started investing. A lot of people have moved into SIPs and mutual funds. So there's a lot of change in the way the marketplace is behaving. Data related to margin funding and the excesses that used to happen there in the previous decade essentially have moved into NBFCs. And a lot of it is needs to be tracked in a very, very different way. But the last item which has reached extreme lows has been volatility itself, and volatility management essentially has been the theme of the last decade or so. And the readings usually don't stay this low for this long. So when you look at even the India VIX, every time previously it had dipped 10%, 9%, it would essentially bounce back pretty quickly. But this time around, for the entire 2-month period, the VIX has fallen to a low and stayed just down there. And I look at the call IV and plot it rather than look at the India VIX, and that reading is coming in at 5.6%. Again, this is the third time it's come in at that level for the last 3 months, which is the lowest in the history of Indian FNO since it kicked off in 2001. So that's where it is, and the same was also seen in the US VIX reaching as low as where it was way back in 1994. And so you're getting these extreme low readings. They probably can't stay there. And you need to be watchful of the potential for volatility to be a little higher or maybe much higher than where we are right now. So that's all in this video update. Thanks a lot, and you can check out the previous video, like I said, and all those updates which are part of the long short report and the resultant updates that I've put out. Thanks so much.